It's tough to justify the current market caps of pretty much, I would say, 95% of the market.
It is tough to justify the market capitalization of at least 90 to 95% of the market. You just heard Sanjeev Prasad of Kotak Institutional Equities mincing no words on the current state of the market. Now, over the last 40 days since the reciprocal tariffs were paused by US President Donald Trump for a 90-day period, the market, according to Sanjeev Prasad, has gone from absolute despair to a state of euphoria. Now, the Nifty too, and that shows in the numbers, right? The Nifty has risen almost 3,000 points from the lows that it had made, sub 22,000 levels. But what is his biggest pet peeve? Now, that is the assumption that everything on the tariff front will be solved, while nothing noteworthy has come up in the first 40 days of this tariff pause. He's warned investors that there will be high inflation in the US because of these tariffs, something that the CEO of the world's largest retailer, Walmart, had also warned during their earnings call.
12% looks too optimistic, I would say. We have only 10% now for FY 2026. That's for the Nifty 50 index. And that is also at some risk because we don't know what happens to many of the global sectors eventually, in terms of growth, given the challenges which many of the countries are facing. You have a lot of uncertainty on the trade tariff issue, which I will talk about later on. So in that context, 22p for the market on March 26 looks on the higher side. The more important thing is not to look at the index as a whole, because anyway, you're not going to buy the Nifty. On any bottom-up first principle basis, it's tough to justify the current market caps of pretty much, I would say, 95% of the market.
Now, last Friday, Kotak Institutional Equities had put out a note on Cochin Shipyard projecting a 60% downside on the stock. Now, that was the week when defense stocks like Cochin Shipyard had gained up to 40%. It was a no-brainer that we would have quizzed him on defense names, and he explained that Cochin Shipyard is trading at a market cap and valuations that are on the higher side, and not just Cochin Shipyard. The valuations of most defense companies currently are not making sense.
You can do some sort of a DCF even for the order book and figure out whether it makes sense or not. I mean, look at, for example, aircraft carrier, which was everybody hoping for Cochin Shipyard will get and make. This story has been going around for 2 years now. Look at the cost of building an aircraft carrier. It will be somewhere about 50,000-60,000 crores here. You take 10% PAT margin here, you will make about 5,000-6,000 crores. That's it. I mean, that's the total value which you will get from making an aircraft carrier, and that is assuming you build it today. If you build it over 10 years, which is probably the most likely time frame, then PV of the 5,000 crores of PAT opportunity which Cochin Shipyard has for making a new aircraft carrier will be far lower. So you have to, even if you take whatever order book you're expecting, take the reasonable profit margin, discount it to today, there is no way you can justify this kind of valuations.
Now, to sum up, Prasad remains cautious on the market, stating that the 12% growth expectations look too optimistic for Nifty earnings in FY26, and that he is not very sure about the argument that FPI flows will return sooner or later to Indian equities despite the recent flux of inflows that we have seen. We'll see how this shapes up going forward.
Thank you for watching us on CNBC TV18. For all news and updates, subscribe to our YouTube channel and watch us on all social media platforms.